What if I told you that undervalued stocks have outperformed the market by more than 800% since 2005? That's the power of the fair value factor. And today I'll show you the data behind it. Our research on 100 stocks since 2005 reveals a clear pattern. On average, it takes about 5 years for prices to converge back to their fair value, the intrinsic worth of a company based on fundamentals, not market hype. The first set of charts shows 4 different ways this convergence happens. Sometimes an overvalued stock declines until it matches its fair value. Other times, an undervalued stock rises until the two meet. In some cases, the price holds steady while the fair value climbs thanks to stronger fundamentals. And occasionally, both price and fair value move toward each other at the same time. These paths prove that mean reversion is flexible but always powerful. Next comes the survival curve. It shows how quickly stocks move back to fair value. Already after a few years, the majority have converged, and by year 10, only a small fraction remain out of line. Clear evidence of how strong this effect is. The backtests underline the point. A sample of 32 undervalued stocks bought in 2005 delivered an average return of 12% per year between 2005 and 2010, compared to just 3% for the overall market. Even over longer periods, the advantage held strong, with 7 to 8% excess returns per year through 2019 and 2022. Of those 32 stocks, 26 eventually reached their fair value, usually within about 5.5 years. And it's almost unbelievable. Back in 2005, I created this list manually and by chance. And now, in 2025, the update is analyzed entirely by AI. And here's the headline result. By August 2025, these same 32 value stocks had soared by an average of 846%. The overall market? Just 162%. The median return was plus 180%, with some names like Goldman Sachs and Eventim achieving spectacular gains, while others such as Leone or Salzgitter lost value, proof of why diversification is essential. The data also shows that the biggest edge comes early, around 9% per year of excess returns in the first 5 years. After that, the advantage gradually declines, though it stays positive even beyond the 10-year mark. The reason is simple. Once many stocks reach their fair value, they tend to move more in line with the market. But the real payoff often comes from just a few huge winners, and you only capture those by holding on. The conclusion is clear. The fair value method isn't just theory. It's backed by hard data and long-term evidence. Undervalued stocks don't just keep up with the market. They beat it by a wide margin. For more detailed insights, visit fairvaluecalculator.com and head to Service Arrow Evidence to learn more.